All right. Hi, everyone. Welcome to a new format on this channel here. We called it portfolio roasting. And a few weeks ago, I think 2 weeks ago or so, I asked my subscribers to hand in sort of an application with the idea that we are going to, quote unquote, roast your portfolio. Basically, we're going to discuss your holdings, share our thoughts on it. And yeah, what the format is all about should become pretty clear throughout the video. And I want to introduce Andrew here, first of all. I think some of you might be familiar with him. I don't even know, Andrew, how many views our interview from last year got. Maybe 1,000 by now. I don't know. I didn't
Maybe.
check.
That's 999 better than I thought it would. So
Perfect. So I assume not everyone will be familiar with you. So I'm just going to give you room like for 1 minute to introduce yourself here.
okay, yeah. My name's Andrew. 28, been investing since probably about 20 years old. And Renee and I, if you're familiar with Renee, obviously, if you're watching his video, he and I have very similar investing philosophies. I don't really need to introduce myself too much on that front. I guess I'm a little bit more consumer facing than Renee. I'm stationed here in the United States, born and raised, so a little more US focused than Renee as well. But very similar on both of those fronts. So that's pretty much all the viewers
I
really
would
need
say
to know at that point. Yeah.
if the viewers want to know more, I'm just going to link the interview we did in the description box down below. Actually, I probably you saw it. I recently launched the podcast where I'm just going to repost some of my video content, and I uploaded our interview on there too. And I think it works really well in a podcast format. So I guess just check out the video. And what I should say, Andrew, is I want to thank you for taking the time to join us here on this channel. I know it's not your YouTube channel, but I hope, and we talked about this beforehand, that we both are going to enjoy it too. Probably will learn from each other here too. And we plan to make this a recurring thing. I'm somewhat optimistic that this format is, I'm quite optimistic that this format is going to work, but we will have to wait and see. But we're not going to give up after two videos of this format, I would say.
No.
Then before we jump into it, I wanted to give two people credit here real quick. So I think around 2 or 3 months ago, I came across a video from Humphrey Young. He has actually quite a big following here on YouTube. I think he mostly does like more personal finance oriented content, but he did one video. I think he has done a couple of follow-up videos in which he, quote unquote, roasted the portfolios of his subscribers. And so I have like a little document in which I note down video ideas, and I noted it down. And a few weeks later, I came across a German channel called Parquet. And Parquet is basically a portfolio tracking solution for the German market, I would say. And on this channel, the YouTube host and another German investor, they have done a ton of portfolio discussion videos. And I really like those videos. And I took a lot of ideas from them, actually. So I wanted to give them some credits here, too. Which brings us to the first person who handed in a portfolio. And this is Danielle. And as you can see, I shared a couple of basic information about him here on this slide. So Danielle is 52. He's an entrepreneur ever since 2017. So he actually started his entrepreneurial journey quite late. He's working as an IT consultant and has previously worked for other, fairly well-known companies, I would say, such as Hewlett Packard in Ireland, smaller businesses in Italy, and Nokia and Microsoft even in Finland. And he now is located in Finland too. So I would say he has lived quite a life, like living in various different countries across Europe. And I think he's actually Italian. You can also tell by his name, and he's now living in Finland. That by itself sounds very exciting, I would say. With regard to his financial situation, so now as an entrepreneur, he makes around 60 to 70,000 euros a year. Obviously, everyone who is self-employed will know that the numbers can fluctuate from year to year. And as of today, he's contributing around 2,000 euros a month to his investment portfolio. And to quote him here, he's hoping to contribute more in the future, once he has paid off his mortgage, which represents an expense of around 1,000 euros a month. So overall, what I would say, if we just look at the personal finance side of things here, he's doing very well. So he has a very solid income by European standards. I know you guys in the US on average earn like quite a bit more, but then you would also have to take into account different retirement systems and stuff like that. But a 40% savings rate, I think is
that's
great.
very good. Yeah, that's very good.
Yeah, and he's investing through his company now, so I guess that is something we don't have a lot of expertise on. I guess that's for tax purposes. Anything you want to comment on regarding his financial situation?
Well, I guess I did just want to say, like, I took some notes, obviously, before this. So just by rough maths, right? He's age 52, wants to work until roughly 70 years old, God willing, right? So that gives roughly 15 to 20 years left of working and saving and investing. By his math, he's investing $24,000 a year. Now, even if we just say 15 years, his goal is to hit 300,000 invested. I did just want to say that, if you do the math on 15 years of saving $24,000 and investing that with a 0% return, that's already 360,000. So right off the bat for him, I would just say set your goals higher, probably, especially if you're pretty confident that you can invest that amount of money. Just because if you can get up to say $500,000, then that would be that would be less assumptions that you have to make for your retirement. But yeah, I mean, as of now, you're not even taking investment returns into that calculation, right? He would theoretically hit his goal with a 0% return on investment just by saving that money. So yeah, I would just say aim higher. Point. Yeah.
I didn't even notice that, and I just moved on to the slide in which I share what he's aiming for, and you already pointed it out. He aims to reach a portfolio value of 300,000 euros by age 70, right? And he then wants to have, so at that point in time, have a portfolio of, at least to some extent, dividend-paying stocks, because he was sharing some calculations about his, living expenses and what kind of income from his stock portfolio he would need to cover those expenses, right?
Correct. Yep.
Yeah. And then maybe a second goal, and I think that's worth highlighting too, is that he wants to pass on wealth to his two sons. And what I have to say is, in the consultation calls from a mentoring program, we obviously talk about personal goals a lot too. And I would say the two most commonly mentioned goals are reaching financial independence for all sorts of reasons, and then also passing on wealth to the next generation. I guess you could bring up the classic Buffett quote here, that you want to be the one who is planting a tree today so that future generations can sit in the shadow of that tree, have an easier life later on.
Yep.
In terms of his investing background, so he started investing in 2020. And just to quote him here, he started very, very late, as I had horrible memories from my parents that got burned in the dot-com bubble and wanted to stay away from the quote-unquote dangerous stock market. Also, the, again, quote-unquote expert that helped my parents once said that the crash seen in 1987 would never happen again, ... Yeah, sure. So all I can say here is, I think this is a common experience people make, that they hear from their parents that they have gotten burned in the stock market at some point in time. If you would ask people in Germany, for example, I feel like if I look at my parents' generation, every second person you talk to will bring up the stock of Telecom, which experienced quite a crash, I think also during the dot-com bubble, and they have never touched the stock market again, which is probably the worst mistake you can make. It's certainly a much bigger mistake than picking one wrong stock. And yeah, he has made the same experiences. His parents probably didn't teach him much about the power of long-term stock investing, and that's why he missed out on a significant part or portion of the compounding journey many people can embark on.
Yes, and I would also like to add that mainly for the viewers, for the listeners, this is also, we're essentially talking about recency bias, and that would be for his parents. Now, the recency bias for us in our generation is essentially, if you've been investing, since 2010 or after, our only experience, other than, maybe a year here or 6 months or 3 months here, is that stocks only go up. That would also be something that we should take into account, that just because we have lived in one of the greatest bull runs in history does not mean that that will always happen moving forward as well. So that's also something to consider. I love people.
Very good point.
Yeah, I see people talking about these, investing and do this basic math and you'll get 10% returns moving forward indefinitely. It's like, well, maybe over a 50-year time span or something, but even over 10 or 20 years, I'm not sure you can just, use the prior 20 years and expect that to be the next 20 years as well.
Yeah. Yeah. For a recent video, I checked the current Shiller PE ratio, and it stood at around 27 times earnings, if I remember correctly. And if you now only assume that, say, in 2035, we are going to be at a market valuation of 20 times, that's going to be a significant headwind over 10 years. And as you rightly point out, when you extend the time horizon, that multiple compression, that will eventually happen. Like, of course, it might also go up again, but at some point, I'm sure we will have a market valuation below 27 times. And this can be a significant headwind. And you rightly point out, it's not certain that over the next 50 years, even, the US is going to produce as fantastic results as it did over the last 100 years.
And I'm not predicting doomsday, of course. I'm just saying it was interesting what Daniel pointed out, and I think it's important to note that on the flip side for our viewers as well. That's all.
Yeah. Maybe one more quote here that just comes to my mind is from Mark Zuckerberg, and it's actually one of my most favorite quotes of all time. He once said that the biggest risk you can take is not taking any risk. And I think that's quite true when you think about stock investing too, because of course there is some risk involved when picking individual stocks, like especially when picking individual stocks. I guess less so when you just bet on the broader market. But the bigger risk would be not to invest at all, and just to be like overly influenced by your parents' bad experience is probably a much bigger risk than trying to pick stocks or investing in the broader market yourself. All right, before we take a look at the actual portfolio, we have to put a big disclaimer here. Obviously, everything we discuss in this video is not investment advice. Basically, the whole purpose of this video is to entertain you guys. We're going to share our thinking regarding Danielle's portfolio, but obviously we are no financial advisor, and we always encourage you to always do your own due diligence, to consult with a financial advisor before making any financial decisions. I think this should be pretty apparent if you watch any financial content online.
And also just to note as a disclaimer, and I know we're saying we're roasting people's portfolio, but Renee and I are both pretty nice people. I don't think there's going to be much roasting necessarily. So
yeah. I also
I just wanted to say that.
I think it takes some courage to actually hand in your portfolio, especially when I was like describing that we are going to do a portfolio roasting series. I guess people could expect that we are maybe be a bit critical when it comes to certain positions. So I think it certainly takes a lot of courage to hand in your portfolio. So I want to thank everyone who so far has sent a message.
Yes, definitely.
And maybe also with regard to the comments we are going to make with regard to Danielle's portfolio, I think it's important to just be transparent about our investment philosophy. What I noted down here on this slide is, I think the English saying goes, all roads lead to Rome, is it? Because in German, in German, it's actually many roads lead to Rome. And the point I'm trying to make is that I think in investing, not all roads lead to financial success. But of course, there are many different ways to achieve financial success in the world of stocks. And we too follow a very distinct philosophy that I think is suitable for a lot of investors. And I would actually recommend many people following that philosophy. But I want to acknowledge that there are other philosophies too. Just to describe our philosophy in a nutshell, so I would say we too really like the art of picking individual stocks. We like to run very concentrated portfolios and with a tendency to own quality businesses. We really like to understand these businesses. We are skeptical of high fees. Anything else that comes to mind?
No, that's pretty much it. And I know as we scroll further, he mentioned Peter Lynch. But if anyone's familiar with, Peter Lynch, Charlie Munger, those are kind of Warren Buffett, obviously. Those are our role models. And I do not, Renee nor I pretend to be nearly as good as them However, that's more along the lines of how we invest. But of course, if anyone's watching your YouTube channel, they already know that. So.
Yeah. I guess Peter Lynch, in a way, is sort of our North Star, so to say, right?
Certainly mine. He's by definitely mine. Yeah.
Yeah, when you introduced yourself, like at the beginning of the video, I was thinking one difference between the two of us, I would say, is that you are much more demanding in terms of how much you want to understand about the company's product or service. I think you're a little stricter than I am. I would say I'm more comfortable investing in a company where I'm maybe not 100% comfortable with, comfortable or like I don't understand every single detail, but if the numbers are right and if it's cheap enough, this can make up for maybe certain gaps in the knowledge area. And I feel like you are a lot stricter in terms of this. We discussed this Japanese name the other day. You might remember, and you immediately said, "No way, I would ever touch this."
Yeah.
And if it's cheap enough for me, this could make up for certain parts that, as someone not living in Japan, for example, would not be able to understand ever.
Yeah. I would say you're probably slightly more quantitative in your analysis than I am. That's all. And yeah, that's probably it.
One more slide before we actually take a look at Danielle's portfolio. I asked him to describe his investing strategy. And again, I'm just going to read to you what he wrote me. So he wrote, after the crazy start between May 2020, so this is when he started, and the peak in 2021, I learned some lessons, though not too hard way. And now I stay well away from things like Virgin Galactic, Beyond Meat. Yes, Bill Gates himself invested there, or Peloton. I would say, maybe just a quick comment on this point here, I feel like a ton of people started investing in 2020. And as you rightly pointed out, there is a lot of recency bias these investors experience over a short period of time. Say you started investing in 2019 or 2020 for a long time, everything was just going up, and it was going up by a lot. Like if you think of Peloton, I don't know how much that stock was up within a year, probably like 300, 400%. And then in 2021, they quickly learned that stocks do not always go up, and they can come down just as quickly. I think Peloton is probably down like at least 90% from its peak. I read a blog from the Substack author Investment Talk the other day, in which he highlighted the performance of 20 pandemic darlings ever since. And oh boy, these stocks are down big time. They have not recovered from their, as I said, 80, 90, 95% declines.
Yeah. As an aside, I was just going to say, as an aside, for any viewers who enjoys reading and wants to learn about market cycles and stuff, there's a phenomenal book called Boom and Bust, and it's actually one I read this past year, so definitely after the that COVID era, 2020, 2021. It was actually after the full rise and fall of these companies. I ended up reading Boom and Bust. And if you want to learn more about market cycles, that's actually a book I would highly recommend. Very well written, very, very well studied, so to say. So
yeah. Other things that stood out with regard to his comments regarding his investment philosophy were that he's rather quality focused now, and also has a focus on dividend stocks. I think I said this earlier. And he also has some exposure to China. So I'm not sure if you would want to refer to this as sort of a strategy. I think it's something that's maybe somewhat unique in today's environment too. I feel like nowadays no one wants to have exposure to China, and he seems to be rather bullish on at least some of the Chinese names. And I guess we can discuss this a little later when we actually take a look at the individual stocks. In terms of the questions Daniel has for us, and maybe some worries he has, I actually asked him to send me a little voice message, and I'm just going to play it to you, Andrew, here. You're going to hear it for the first.
In a nutshell, I'm a bit late to the investing game, with just about 14 to 16 years left for active investing before retirement starts knocking on the door. And while I've been consistent in my investment in dividend paying stock and will continue with that, maybe I need to focus more on capital gains too. So thinking like about leveraging the growth stock in my portfolio, Google, Facebook, and maybe sell them as soon as they hit 50% gain. Maybe that could be an approach. Surely I won't get my son to be late in the investing warden as he turns 18 in January. First thing we're gonna do on that day is to open an account on the Giro and start his investment journey. But it's never too late to invest in your future, also for myself.
All right, I'm not sure how much you understood there. I think the audio quality was probably not ideal for you, but again,
No, I can hear.
Yeah, perfect. Summarize the key part. So first of all, I really like his humbleness. Like, he's not regretting starting a little later. He just thinks better late than never. Yeah,
I'd agree.
The best time to start investing was yesterday, and the second best time is today, right? And I think then he was articulating the question whether he should get more exposure to more growth stocks. This is what I was understanding, and reduce maybe his exposure to dividend-paying stocks. What's your take on this?
It's tough because so I know you and we're not even 30 years old, right? It is tough. I understand when someone's closer to retirement, although he wants to keep going another 15, 20 years, God bless him. But yeah, obviously when you get closer to retirement, you'd rather, if your goal isn't to be the next Warren Buffett, obviously, and just keep compounding forever, you do want to be able to withdraw from those gains. So dividend payers make sense at that time. But I mean, if he is planning for another 15 to 20 years, yeah, I mean, focus it. But you and I don't really focus on growth or value. It's kind of, it's all joined at the hip, so to speak. And I don't really worry about whether a company pays a dividend or not. That also doesn't really mean much to me right now. So all I can say is from my experience, I would get those preconceived notions out of your head, like, oh, I'm looking for a growth stock, I'm looking for a value, I'm looking for a dividend paying stock. Just look for a really great business that you can understand that is trading cheaper than what you believe it to be worth, right? Like that would be my best piece of advice. And I know it's extremely simple, but it's also easy for me to say when I have, God willing, 40, 50, 60 years of investing ahead of me. But yeah, to focus on dividend versus growth,
sort of an artificial distinction, right?
Yeah, exactly. And, you and I, we're not financial advisors. You could also toss that in the disclaimer there too, but we aren't financial advisors, right? So it is tough for us. So if you're coming to us for answers, we're going to give you what we know and what's worked well for us. But like you said on one of those previous slides, right? Like there's many roads to Rome, so to speak. So but yeah, if it were me, I would not focus on distinguishing one between the other.
Yeah, 100%. I fully agree with you here. Maybe two more thoughts here. So I would say, all things being equal, if I would get the opportunity to receive a dividend and reinvest it, say at a rate of around 10%, or invest in a company that is not distributing any cash flows, but reinvesting internally and also earning a 10% return, I would prefer the latter company, just because it doesn't have to pay taxes on those internal reinvestments. While if it would distribute, say, 10% of revenue, whatever the profit margins may be, I don't get the 10% of revenue. I would get, depending on the taxes I have to pay on this dividend payment, so a little less, right? And then secondly,
sure. Yeah.
I fully agree with you. I think it doesn't make sense to artificially limit the universe, like the investable universe for you. So I know there are a ton of very successful financial content creators with a focus on dividend stocks, but I don't know why you would artificially get rid of all of the other companies that are not paying a dividend. On the flip side, the same is true for growth investors. Why would you not take a look at a company that is paying a dividend? Meta, for example, is now paying a dividend. Why would you want to exclude this company just because it started paying a dividend? So at the end of the day, as you rightly pointed out, you want to value companies independently. And if that value is significantly higher than the public stock price, of course, you want to invest here regardless of whether the company is paying a dividend or not. And maybe lastly, I have one more thought here. I feel like what makes dividends so compelling to many is that it's more tangible, so to speak. But you have to realize that you can generate income from other sources of the stock market too. You can also just sell shares every once in a while and have a cash flow from that stock sale as well. And I think Buffett once wrote an article on this, actually, that over the long term, you may actually end up better following this strategy if the company can reinvest earnings at a high rate than, say, having a dividend stock that pays out 90% of its income, but isn't really growing as a result.
Well, one thing I can speak from experience, and which is why I understand the dividend aspect of things, is because, so in my early 20s, when I was trying to find my way, right, I did stumble upon dividend growth investing, which was only investing in dividend payers that had a long track record of growing their dividend over time. It is a lot easier to hold on to that company when it goes up 50, 100, 200%, because you're not really focused on the capital gains of that company. You're more focused on that income coming in every 90 days or whatever it may be. So speaking from experience, I can say it is a lot easier to hold on to those companies. So if it's a psychological thing for someone, and that's a psychological hurdle for them to get over, for example, and I know we'll get to later, but if although Meta, I guess technically is paying a dividend now, but let's say he owns a Google or Amazon, which of course we'll see that he does, but those companies that don't pay a dividend, when those go up 50, 100, 200%, even if it may be still fairly valued, it is very, very tough to hold on to those companies. Speaking from experience, right? And I know Renee is actually better at that than I am. I do have that psychological issue because it's like, well, I've already gotten these gains, but they're not paying me out anything. They're not paying me the cash flows. So it can be very difficult to hold those companies. So dividend growth investing, if that is your issue, that might work for you, right? That might work better for you if that's a psychological issue that you run into. But if you don't have that issue, then other than that, it makes no sense to me anyway.
I think I might be wrong here, but if I remember correctly, I think Google actually announced their first dividend in the last quarter. So I feel like Amazon is one of the only big tech names left.
Yeah, and if Jeff Bezos, right? If Jeff Bezos has a say, even though I know he's still not around technically, I'm still I'm pretty certain he still has a say. He probably will not be paying a dividend. So he has one of the greatest investment minds of our generation. So yeah,
that's right. Maybe one last comment on Danielle's message. I think he also brought up a point. I'm not sure if I fully got his point, but I think he said he would consider selling out of these more growth-oriented stocks after a 50% gain. Is that how you understood his message too?
Correct, yeah. And which obviously I think you and I probably both disagree with that.
Yeah, that's anchoring bias, right? Why would you sell after 50% gain? There would be a case for selling if the stock goes up 50% and the value of the company at the same time remains stagnant. But what if the value increased in line 50% over that time period? So this is what the mindset you should approach these decisions with always. Where's the intrinsic value at right now, or my intrinsic value estimate, and where's the share price? And ultimately, the best performing stocks in your portfolio over a long period of time, they're going to drive the majority of your overall portfolio performance. So it can be a very dangerous game to sell your winners after a quote unquote small gain. Obviously 50% is great, but if that stock continues to go up, say 1,000% over the next 10 years, this was likely one of your biggest mistakes over that 10-year period, even though you locked in a 50% gain. Andrew, I think we two always run the risk of talking too much, and I actually have the internal goal of keeping this video under 60 minutes. I'm not sure if we can do it, but
I'm refraining from talking, from commenting much. I might be tough to believe, but I'm actually more talkative than Renee. So
yeah,
100%. I'm trying to bite my tongue here.
So the point I wanted to make is, let's move on to the next slide. So on this slide, you see his asset allocation. So as of today, his portfolio is worth $78,000, almost 79,000. And he has some exposure to an ETF, which I will show you in just a second. And then he also owns a holiday home, in which he also owns equity of around $108,000. So I guess that is worth taking into account here too. But he has quite a high allocation to stocks overall, which I like to see. I mean, I believe that stocks are one of the greatest wealth building instruments out there. that is accessible to most people. So I like what I'm seeing here. No bond exposure. What do you think?
Yeah, I agree. I don't have any experience with real estate other than owning a home, but that's also a great alternative.
Yeah,
asset.
and he doesn't consider it as an investment.
Okay.
I just wanted to include it as well because relative to the worth of his stock portfolio, it's not insignificant. And I'm not quite sure if he actually lives in his own property as a main residence too. I think Danielle might just post a comment below the video in which he answers some of the questions we still have. Yeah. Okay, next slide. Oh yeah, here we see the ETF he's investing in. So this is a typical S&P 500 ETF. The expense ratio is actually incredibly low at 0.03%. Obviously, you get a lot, or not a lot. You get exposure to the US market exclusively, but then at the same time, most of the S&P 500 members are global companies that are generating revenue globally. So you might not be as concentrated to the US market as you may think. Good choice, I would say.
I agree.
What you see here is the geographical exposure. If we would benchmark it to the MSCI World, that's the mindset I approached it with. He is actually underweight the US because in the MSCI World, 71% of the constituents are actually US companies. His portfolio has a 35% exposure to the United States, followed by, now I have to move my camera a little bit, Canada. And so he clearly has overweighted Canada because in the MSCI World, again, relative to the MSCI World, Canada only represents 3% of the overall holdings. And then you have some other quite interesting nations in there too, especially the Netherlands and Sweden, right? I think those are interesting stock markets that aren't getting a lot of exposure in the broader market indices. I mentioned China too. So Andrew, any comments on the geographical?
I will just say for the next few slides, I have zero input and zero care whatsoever. I don't care where you're investing. I don't care what categories you're investing, as long as you're doing it with the intention and the a framework in mind, and you think you're picking great companies below the prices that they should be trading at. So that I don't care about geography or anything like that, to be quite frank.
You can see it on my screen here on the left hand side. So this is a note actually noted down too. So I would say if someone would have a larger exposure to passive instruments and ETFs, I think then the whole discussion about what kind of geographical exposure you want to have becomes much more relevant. If you, like Danielle, run a fairly concentrated portfolio of individual stocks, the business quality is obviously much more important than the geographic exposure. So I would much rather own, say, 20 companies located in just one country. This is what Buffett has pretty much done most of his life, right? But those companies are of incredibly high quality than, say, own 20 companies in 20 different geographies, but those would be of lower quality. I think that's kind of the mindset I would approach it with. And the same is, of course, true. You already hinted at it. With regard to the sector and industry exposure. What I would say, however, Andrew, is I definitely care much more about my industry exposure than the country exposure, because I think there are just good industries and bad industries. There are certain industries that I just blatantly fully avoid, and other industries where I actually like to get more exposure to than, say, some of the most common indices would give me.
Correct. I would agree with that. And actually, I have some comments on certain industries as we move forward. I guess the main meat and potatoes of what I was trying to say was just, is mainly focus on the business, looking at the business, and don't go looking for a specific country or for a specific industry. If it happens to be, you'll find, especially if you just run a basic something like a stock screen or something too. I mean, certain industries have naturally better businesses in it, but I would say don't put blinders on when you're investing. That's all I'm trying to say.
Yeah. But let me just highlight the key sectors Danielle has exposure to. So the financial sector is actually the largest one. And I would say this is a sector, if I would have to rank it with regard to other sectors, I would probably put somewhere in the middle of the pack. I wouldn't be extremely excited about getting a lot of exposure to the financial sector because you just own a lot of banks in there, which we will get to once we look at the individual names. But then again, you and I, for example, we have exposure to IBKR, so Interactive Brokers, and I guess they would be grouped or categorized as a financials company.
Exactly.
Yeah. And the same is true for Wise, which you now own a little bit of too. But I would think of these two names, and I think you once articulated this in a voice message to me that you sent to me, rather as tech names actually, because what they are doing is they have extremely good technology with regard to their offering. And I think they are less so like pure financials companies.
Yeah, I mean, it's not too much different than, like, for example, like a Meta. I think it screens as information technology. It's really a media company, though. So, yeah. There's a lot of, cross-categorizing that you could do with many companies. So,
yeah. Then the second largest weight in terms of the sector exposure is the communication sector, followed by consumer staples, which you are a big fan of, I would assume, just because you understand these businesses very well. Consumer discretionary. Utilities is maybe a little, I would be more skeptical when it comes to utilities.
I have a comment on utilities later, but yeah.
Yeah, National Grid, right?
Correct, yeah.
And I guess what also stands out is his underweighting of the IT sector. But then again, the whole classification of what bucket companies fall into is a bit artificial. But I would say if we, again, were to rank different sectors in terms of their attractiveness, the IT sector would certainly rank up high up there. Can you still hear me, Andrew?
Oh yeah, sorry. I thought you were just talking. I agree. I concur.
Nothing to add. Okay, then let's move on. And we are approaching the end of the video now, but I guess this will be in the most interesting part to his actual stock portfolio. So let me just describe his overall portfolio in terms of the level of concentration and also the weighting of different positions. So when I described our investing philosophy, I said that the two of us, we like to run a concentrated portfolio. I would say one of the main benefits of it is that it gives you the best shot at actually outperforming the market. It's really hard to outperform the market once you own 30 stocks or more. And one other advantage that may be even more important is, I think when you run a concentrated portfolio, you actually have a chance of understanding the members of your portfolio very well. And again, once you get to too large of a portfolio size, this just gets very difficult keeping track with what's actually going on at the different businesses. And Danielle is running a fairly concentrated portfolio. So overall, he has 22 positions. That's probably like towards the higher end I personally would be comfortable with.
I mean, especially one of those holdings is an ETF too. So my comments on it would actually be it's not concentrated at all, in my opinion. But
yeah. If we look at the top 5 positions, Andrew, I would disagree with that because his top 5 positions represent.
Well, yeah, that's true. Yeah, that's actually a valid point. Yes.
Yeah. The point I wanted to make is, just from my personal experience, I would say if you would ask like just a random investor and would ask him whether a portfolio of 22 stocks is concentrated, he would probably say, yes, it is. Because I feel like a lot of people run portfolios of 50 to 100 names. So they just keep adding new stocks they hear about, say, on social media or in podcasts or whatever. And then it just becomes impossible to keep up with the businesses, right? So I feel like 22 stocks or 21, if we eliminate the ETF, is something that is manageable. You won't understand the companies to the same extent someone understands his companies if he runs a 5-stock portfolio, but you don't, depending on the quality of the businesses, you don't necessarily need to. Mm-hmm. Andrew, the stage is yours. Feel free to comment on the portfolio construction.
Yeah, I mean, the first few. I guess my main issue would just be on the. And if you guys see me looking down, I have it pulled up on my phone here. I guess my main issue is when you start to get down to the latter half of the portfolio. Mainly, it's just what it strikes me as anyway. Is just, and if it were me, of course, I can't really give you advice. There's plenty of ways to do this, but if it were me, I would say, well, for example, here's Archer Daniels all the way at the bottom. Okay, that's 1.5% of my portfolio. Do I like Archer Daniels more than Amazon, more than Starbucks, more than Meta, right? You have to start weighing it against other investments. And when you really do that, if you were to sit down and really do that, I think you would get this probably to about a point where you can get this to about 10 holdings or so. And then around 10 holdings or so, you're probably going, I pretty much like these all equally, you know, based on valuation, based on portfolio weighting and all of that. So for me, I think it would be easy to say, do I like Meta and Amazon more than I like Dr. Martens or Archer Daniels? I think that's a very easy hurdle. But if I had to pit Amazon against Meta, that's a lot more difficult, right? So I think there's certain probably there's some low hanging fruit that he could probably cut out here. That's just, I think if you're really going to be an investor and take this seriously, stock picking seriously anyway, you need to build a very strong sense of conviction. And I get it. I know at one point he mentioned Peter Lynch. He said it was actually his main question was, I wonder if I'm too diversified. And then he mentioned, well, maybe I'm not, because Peter Lynch was extremely diversified. Not in Peter Lynch's personal account. He actually mentioned for the individual investor, you only need a couple of names throughout an entire lifetime, a couple of winners anyway. Obviously, you're going to cycle through more names than that, but you really only need a couple of winners. Peter Lynch only had that many stocks was because he was running a mutual fund that was constantly getting new inflows because of how great his performance was. So he constantly needed to be adding to different positions. And then he would always have a lot of 0.5% positions or whatever it was, because they, naturally you would get redemptions as well. So his investing scenario through his prime time, through his heyday, is a lot different than, you and I and probably anyone else watching your channel, right? So I would say for us, you really need to build conviction and really make a call. For example, Starbucks versus Nike, that might be a tough wait, right? But for example, Starbucks versus National Grid, probably a little bit easier. But I guess that would be those would be my main.
Let me jump in here real quick.
Yeah,
so
go for it.
First of all, I think what's worth highlighting here is, and this goes back to the comments you made with regard to a dividend-focused approach. I think what's very important to understand is, if you do decide to run a portfolio of, say, 10 names, you have to be much more comfortable with the volatility that comes with running such a concentrated portfolio. I think it's very important to be aware of the fact that if you don't have the temperament to run such a portfolio, you will be much better off by running a 20 stock portfolio, just because it will reduce the risk of making emotional decisions and emotion-driven mistakes, so to say. So I think that is one advantage of diversifying more than the two of us would.
Yes. I think, and I've actually spoken to someone about this before. My take on that, which is a very valid point, is why not then, if you want to be extremely diversified, get your dividends or whatever, focus on, the Schwab dividend ETF or a total world index. Make that, instead of whatever the weighting is here, his S&P 500 is only 3.5%. Instead of making that 3.5%, why not make that 33% of your portfolio? And then you can you already have most of the diversification that you need. And then the remaining 66% of your portfolio, you could really hone in on 5 or 10 different names, names outside of the S&P, or I guess when they're really out of favor. For example, just because Meta is in the top 5 names in the S&P doesn't mean that you shouldn't buy Meta if Meta is trading at an extremely deep discount. But I don't think there's, a need to. Some people own the S&P 500, but then, they'll have all 7 of the Mag 7 in their portfolio, as well as the S&P 500, which obviously makes no sense.
Yeah. That would be my take anyway. Before we discuss individual names here, let me just say, first of all of the pie charts and also the table you can see on screen right now, they are created with Koyfin. So that's like a super helpful tool. And what I want to address now, Andrew, is the bottom row of this table, because it shows the so-called weighted average of your portfolio. So I think this is a super cool feature. So if we, for example, look at the valuation columns, the price to earnings ratio, the 17.5 times, that's the weighted average price to earnings ratio of that overall portfolio. And again, as the name suggests, it takes into account the different weightings within your portfolio. And Andrew, I'm not sure if you can read it because I know there are a ton of numbers on here, but if you take a look at the weighted average row, does anything stand out? Because what I'm seeing here is I actually see quite a reasonable valuation for the overall portfolio with regard to the different metrics. I also like the, I'm not sure if you can refer to it as long-term growth, but the 3-year revenue growth rate compounded, which stands at around 15%. I think that's a decent amount of growth, and most certainly, yeah, it is above the growth rate of the S&P 500 as a whole. I think that's probably around 5% if I remember correctly. In terms of the profitability, and I have to move my phone to the side a little bit again here. The gross profit margin, it's not particularly high. Actually checked before this year. I think the gross margin, like the weighted average in my portfolio is, I think it's above 70%, but that's already really, really good, right? So you have to be aware of that. The EBIT margin on the other hand is looking really good. So 24% look through operating margin for the portfolio. I think that speaks of probably an above average quality portfolio. And maybe one last comment before you take over with regard to the weighted averages. In terms of the different market cap sizes of the companies, there's a nice mix of different sizes too, right? So you have the really big companies like the Meta and Google as his top weighting, but then you also have smaller companies in the range of, say, probably the mid cap range of, say, 20 to 60 billion, 60 billion market cap. And again, I kind of can anticipate what you're going to say in terms of your exposure to different market cap sizes. It's obviously much less relevant than the business quality.
Yeah. Yep. Yeah, I've had in my portfolio many times all small caps, and then I've had all mega caps at some points too. So I'm pretty agnostic to market cap. Obviously, I'd prefer smaller cap companies just because there's a longer runway for growth. But if you're going to offer me one of the best companies in the world at 10 times earnings, obviously I'm going to take it. So agnostic of the size. But yeah, no, I mean, overall, it's fine. I guess I don't really... I know Terry Smith looks kind of weights his portfolio in a very similar way. He does it free cash flow and ROIC metrics. So I mean, yeah, at a basic look through, everything looks pretty fine to me.
No
like for example,
right?
Yeah, I don't really have too much to add to it, just because, and like I don't know how much of it is synthetically brought down. For example, his second holding, which I know nothing about, it's at a 10% weighting, the INVEA, right? I know nothing about that company.
Let's take a look at this company. Actually, note down that I don't know much about it too, but it might be interesting to just take a look at the numbers here. I know you're more of a qualitative guy, but let's take a look at the numbers. So let me just read to you what the company actually does. And I looked at it like 2 or 3 days ago, and to be honest, it's rather vague. I didn't fully get what the company is doing. So Investor AB, and I guess that's a Swedish company, and I've seen this AB next to Swedish publicly traded stocks, but does it reveal it here? It doesn't say the location. Let me have a look here. Where is it located? I can't find it. Anyway, so Investor AB is a venture capital firm specializing in mature middle market buyouts and growth capital investments. It is operating through 4 business areas, including core, private equity, operating, and financial investments. For core investments, the firm invests in healthcare, financial services, IT, and fintech. And then the description goes through the 4 different areas or segments, so to speak, right? So venture capital firm, that's like very hard to assess it for us as individual investors, right?
So that's, yeah, so really for that company, you would have to say, hey, I know who the guy running this venture capital firm is, and he's an extremely great investor within great investor mind. At that point, yeah, I guess it makes sense to put money behind him. But that kind of alludes to the point that I was trying to say, which is that, at a 10% weighting, it's latest 12-month price to earnings ratio is 5 times. It's a venture capital firm. The price to earnings ratio is virtually irrelevant, I would probably say, which is, like I said, there's probably some companies that are kind of synthetically either bringing some of these numbers up or down. So maybe the weighting or the averages for the entire portfolio probably are probably less important than some people might think.
Yeah. I just opened the valuation tab on Ticker, and the valuation metrics, like the multiples without knowing much about the business itself, look very cheap, right? So you point out price to earnings ratio 5 times, price to free cash flow was around 8.6 times. So this looks extremely cheap, and I think it's a growing company if I remember correctly. So if we take a look at the revenue development ever since 2016, for example, they actually doubled their top line ever since 2016 from 31 billion. I'm not sure if that is in a foreign currency. Yeah, I think that's Swedish krona actually. Yeah, to 60 billion.
Yeah, I guess my main concern with it would just be it's a venture capital firm in another country. I just don't know what those accounting standards would look like. Like, I don't know what they're counting as earnings, what they're counting as revenue.
Yeah. Maybe Danielle can comment down below what his investment thesis for this company is, because clearly we can't add much value here because we don't know much about the company. But just structurally, it's probably not a competitively advantaged company, and rather bet on the manager or the management team of that particular company, right?
Mm-hmm.
On the flip side, I guess what I like about this name and the weighting of this name is that it's not your mainstream stock pick that you will find on mainstream financial media. So apparently Danielle has found it somewhere. I find it in, like, if someone has, say, Swedish companies in his portfolio, that is something I like to see, like, broadly speaking, because then you are basically looking off the beaten path, right? So generally, that's something I would actually flag as something positive.
Yeah.
Then
I just want to so since this is so-called roast the portfolio, I do just want to, I typically don't, I like to talk about the good things in a portfolio, but I guess because this is a roast, I would like to nitpick the specific names that did stand out to me, which, if, like, so many of these companies, actually most of these companies, I either don't know, don't understand, or I would say, for example, a Starbucks and Nike. I'm not really interested in it, but I can see the appeal, so I'm not going to really point that out. Certain companies I do really like, Meta, Amazon, Alphabet, right? Like, those are obviously great companies. Alibaba, I can see the appeal. Renee knows my history with Alibaba and other Chinese companies there, so we won't get into that. But there's 3 names I will specifically point out. The first being Tyson Food, right? So I guess it would be a fine inflation play, and which did play out over the past several years, but their historical ROI is typically around 10%. It's really not a great business. And also, I guess my biggest concern with that is their CFO. So it's Renee, I'm not sure how familiar you are with Tyson Foods. You probably have
not at all, but just looking at the numbers, I can immediately tell that's probably pretty poor business. There's also like not only low ROE and ROI, but also very little growth over the last 3 years.
Yeah, it's a commodity type business with a brand name. There is a brand name, so Tyson Chicken and all of their meat products and other pre-frozen packaged products, right? My issue, so I, as we've discussed actually when I was featured on your channel and we were discussing last time. We're gonna have to wrap this up soon. I'm having battery issues here, but Tyson, their CFO has had a lot of, it's a family-run business. They have all the voting rights. The CFO is the great-grandson or the grandson or something. He has a lot of issues with the law. So not really a fan there. There's a little nepotism to play, and he's the CFO, so in charge of the financials. Not really comfortable with that. I'd probably prefer a company like Pilgrim's Pride, but still, it's a food packaged company, not really a fan of. National Grid, utilities kind of trade like bonds. And so I actually work for a utility company. Moral of the story, utility companies are great inflation hedges, interest rate plays, if you really want to play them that way. They're great to build income for your family, but they are terrible investments typically. And then ADM all the way at the bottom, Archer Daniels, is also similar to Tyson. It was an okay inflation play, but same thing, 5 to 10% ROIs historical. It's a pretty mediocre business at best. So
yeah, the growth rate for Archer Daniel is actually okay over the last 3 years. So
yeah, since COVID,
yeah. Maybe broadly speaking, with regard to these consumer package companies, I would say that they have come under pressure probably over the last decade because private label has become more of a thing and become more popular overall. So that's just a general statement I can make here. I feel like Buffett got burned with his Heinz investment, right? So that would probably fall into the same bucket here. How much battery do you have left? Does it?
I probably have to go soon. One thing I will say, if we're talking about food products, food companies, or food versus beverage, and actually maybe Renee can have me on to discuss the beverage industry in depth. But if I had to choose between a food company or beverage company, I'm going beverage all the way. It's a much better much better category to be an investor in. But that's a topic for another day.
Yeah, I think I can wrap it up in 5 minutes, but I'm not sure if you have 5 minutes. I don't want you to get
no. If I drop out, I drop out. It's fine.
Okay,
you can probably keep going.
All right. So the only a few things. So Alphabet as the largest position by far, 20% weighting. That is something I like to see. I think Google is a fantastic above average business, trading at a market multiple pretty much right now. Obviously, there's the whole breakup discussion right now, but didn't really hurt the stock price. And what I was reading is that the market as a whole is first of all anticipating that the chances of this materializing is pretty low, and secondly, it will take a long time probably if it were to happen at all. And maybe lastly, I own Google too. I think ultimately a breakup might even unlock shareholder value, so I'm not too worried about that. I also noticed that there are a lot of larger banks in his portfolio, and I would say, on average, banks are not the highest quality companies. So if you think about what banks have to offer, they are largely also providing a commodity product. I know that there are banks that are somewhat unique in how they approach their business. But again, broadly speaking, banks are probably a pretty commoditized business.
Yeah, and banks have to leverage up in order to earn. If you see a bank earning an above average ROE or ROA, it's typically because they're using leverage to do so, which and maybe, if they're not properly matching their short duration to long duration, and the risk management and all those other ways. I mean, banks is it can be a real risky place to invest. And if you want to earn above average returns, typically you have to take above average risk. And, where that's not necessarily the case with many other industries. But of course, there's always exceptions to that rule.
Yeah. So. And then one last comment with regard to the individual names. What I did like was that there are some, I refer to them as contrarian picks here, like Starbucks, Nike, to some extent Amazon and Alibaba are certainly names that have not received a lot of love from the market over the last year at least. So I kind of like that contrarian mindset. I just wanted to comment quickly on Starbucks. Not sure if you have thoughts on it, adding 20 billion in market cap just because of a new CEO. Is this ever justified?
Is it? I guess you could probably find the time it has been. Typically that actually doesn't work out. And if you want to learn more about that, I would recommend listening to the Focus Compounding episode where they talked about that. Jeff Gannon discusses this one. He discusses that exact situation, and historically that usually never really works out that well. When you bend over backwards for a CEO, typically it usually doesn't work out that well. But I'd point you to go listen to Focus Compound.
I would argue that both Starbucks and Nike are high quality, above average businesses. In terms of Nike, I'm not sure if I would invest at these levels, and I don't own Nike, so I haven't made that call so far, and I'm nowhere close to doing it. I was just running some numbers with regard to the different sources of where the return might come from. So if we just assume that over the next 5 years, Nike can grow its top line, oh, no, sorry, its earnings at 5% annually. So they actually haven't grown their earnings all too quickly over the more recent history. If the multiple stays flat, I think Andrew left us here, and if they can buy back around 4%, a little more every single year, you still only end up with a return of 9.8%. So that's pretty much a market return if you take into account the somewhat elevated valuation of the US stock market. Maybe you even end up outperforming the market. But the point I wanted to make is I'm not sure if Nike is going to produce stellar returns going forward. I don't think it's cheap enough at 22 times earnings. I would argue 22 times earnings is certainly justified for a company of the quality of Nike. I would be very confident when it comes to the quality you get in Nike, the business. I would also be very confident that this brand will still be around 15, 20 years from now, much more comfortable or confident than, say, in Lululemon, for example. But is it worth 22 times if it's only growing at a single-digit rate? I don't know. I guess the bull case would be that management starts buying back shares more aggressively, so you probably end up with a higher earnings per share growth rate. But I don't know. It's not cheap enough for me to start investing here. What I will say is I don't have performance data with regard to Danielle's portfolio. Hopefully, we can get our hands on that with regard to future portfolio roastings. What I can show you here are his most recent buys. So if you have any comments on that activity, as you can see, Investor AB was probably, I'm not sure if it was initiated in 23. I would assume so. And more recent purchases have been Amazon, Dr. Martens, Nike, Starbucks, Archie Daniels, and then a few names I don't know much about. Kainos Group, never heard of that company, Rubis, Acomo. If you have any comments on these names, feel free to share your ideas and thoughts in the comments down below. So what's my conclusion here? I would say that overall, Danielle runs a somewhat well-constructed portfolio. I like the level of concentration we are seeing here, even though Andrew was highlighting that he would actually like to see a higher level of concentration. He does own a couple of above average businesses. There are probably a few businesses in there that you might consider getting rid of, Danielle, just because of their lower quality. But keep in mind that we don't know much about these businesses and can only judge them superficially. I would hope that you have done a ton of research on these names and know them just much better than we do. So feel free to contradict us here. What I also want to point out is that you can apply for this portfolio discussion, portfolio roasting format too. So feel free to just send me a message on either Instagram or on X, formerly known as Twitter, and then we'll have a chat. I'll send you a couple of documents that I would ask you to fill out. And obviously, we ask you for your feedback. How did you like this format? Anything you would like to see that we haven't done? Anything you would like us to get rid of? This is what will make us improve this format over time if you actually take the time to tell us, well, what is working and what isn't. I think we're probably towards the longer end in terms of the length of this overall discussion that I was aiming for, but I hope you still found the discussion valuable. And I guess I'll wrap it up here. I'll see you in one of my next videos. If you don't want to miss out future portfolio roastings, make sure to subscribe to the channel. Yeah, and that's it. Take care.